Good morning, everybody. My name is Roberto Barros. I am the head of the finance and project finance practice of Campos Mello. First, I would like to thank everybody for joining us today for this webinar, such a difficult subject, but at least we'll be able to eat a lot of chocolate Easter eggs during the weekend. So that's always something that make us happy. Let me give you some messages before we start. You may ask questions through the chat, okay? So if you want to ask any questions, you can do it through the chat. We will answer as many questions as possible in the last 15 minutes of the webinar. But in any event, questions that are not answered in the webinar will be answered by email later on. We have already made 7 webinars at CMA, and another one will happen next Monday, April the 13th, about tax. And you can get more information about that on CMA social media platforms. Finally, we'll be recording the webinar and making it available in our social media by this Thursday, April 9th, okay? As you all know, we are currently undergoing the most severe health crisis of our generation. The crisis will have a huge economic impact, both on global and local economies. The OECD says the coronavirus outbreak has already brought considerable human suffering and major economic disruption. Output contractions in China are being felt around the world. Subsequent outbreaks in other economies are having similar effects, albeit on a smaller scale. Growth prospects remain highly uncertain. On a best-case scenario, the OECD is forecasting annual global GDP growth to drop to 2.4% in 2020 as a whole, from already weak 2.9% in 2019, with growth possibly even being negative in the first quarter of 2020. In Brazil, the Focus report is projecting a negative GDP growth at around 1.2% in 2020. Clients across all industry sectors confront unprecedented long-term operating and financial challenges as a result of this crisis and are seeking to implement measures to preserve cash and maintain financial flexibility. Based on that, we will discuss today the legal, financial, and practical issues to be considered under applicable Brazilian and U.S. laws in positioning your company to successfully execute a financial restructuring. To participate in this debate, we have here Chris Patchy. Chris is a partner at DLA, chair of the Capital Markets Practice Group, and is based in New York. We have also from DLA, Rick Chesley, co-US managing partner, global co-chair of the restructuring practice, and based in Chicago. From Campos Mello, we have Marcos Bittencourt. Marcos is partner, co-head of the corporate M&A practice and head of the private equity and venture capital practice. Marcos is based in São Paulo. We have also Leandro Rinaldi, the head of our insolvency and restructuring practice based in Rio. We also have the honor to have here with us Sam Aguirre. Sam is a senior managing director in the corporate finance practice of FTI Consulting. He specializes in debt restructuring advisory in the Americas. Prior to joining FTI Consulting, Sam was a partner at PwC in the corporate recovery area. Sam trained in Canada and gained significant experience in formal bankruptcy proceedings, out-of-court restructuring, and operational restructuring. So without further ado, I'll give the floor to Sam to discuss the major economic and financial impacts of this crisis. Sam.
Thank you, Roberto, and good morning, everybody. Let me expand on Roberto's introduction a little bit more and get into a couple of insights on the economic and financial issues. The news that have been coming from abroad have been, frankly, very surprising, even for restructuring advisors just like us. The fact that a survey came out yesterday that basically says 3/4 of Americans have been impacted at the income level, right, because of the coronavirus. Of those, half said that they would be without income if they were to fall ill. This is a country with a significant safety net, and that's why I'm bringing it up. The U.S. already has 10 million of unemployment claims. That was as of last week. April numbers are going to be probably terrible. So the reason why I'm doing this parallel is because obviously we're a little behind the curve here in Brazil. The economic crisis in Brazil has hit the country before the health crisis and probably will last longer because of that tail. So we can draw some parallels between what is going on in other countries and what's going to happen here. So the difference primarily is Brazil obviously has a lower safety net, although the federal government is putting some relief in place, but the impact will be enormous for any business that relies primarily on consumer spending. We're going to see significant suffering, in my view, at the low-income classes, which has obviously a large proportion of the population in Brazil. People have changed their behaviors. You have changed your behavior. I have changed my behavior. We're not going out today. We're in lockdown. For the economy to recover or to pick up, really, it will take some time, and we have to obviously get confident in one another that we're going to be able to work outside of our homes. That's how the economy will really, hopefully, recover as soon as possible. There's a range of GDP forecasts for Brazil today. I think everybody has access to Focus. Everybody has access to, the bank's numbers. But one number came out last night, which was particularly interesting, which is the OECD project, the forecast. At least it's the initial forecast for 2020 for a number of countries. Fundamentally, the emerging countries are in the range of 20% less GDP compared to last year, which is gigantic, really. And for the developed countries, we're looking at 25 and upwards, up to 30%. 20% in Brazil, out of 7.53 trillion would be, almost 3 billion or 3 trillion reais, which is really hard to understand a number of that size. So let me do a little math just to put into context what is the relief versus what we're seeing in terms of, deficit, certainly at the primary level of the government, or the government at least intention to do relief in the market. So as Brazil GDP is about 7.5 trillion, let's just assume for a second that the impact is not 20% and it's not 2% like the government says, but let's put it in the middle. Let's say 10% for argument's sake, which I think it's a low number, but let's work with something simple. That's a 750 billion loss of GDP. That on itself, just to be able to compare us to what that means in terms of income for people, it is enough to wipe out a significant portion of the entire labor income for the entire year in Brazil. So what the government has put in place is actually a Band-Aid or relief that may be good for 3 months, and this is for the lower classes of people. We're seeing from a monetary perspective, the relief that's been given is about 150 billion worth of checks that are going to be distributed for the next 3 months, that being for about 50 million people in Brazil. To the extent that, the coronavirus takes longer, and it will certainly take longer, well, they're going to have to double or triple that number. So in terms of monetary stimulus, I got to believe that the number is still low. These numbers were worked out by the government 3 weeks ago. They're going to have to revise their numbers pretty quickly, and they're going to have to put significant more money. Right now, at least the governments are not really caring as to how much they spend on a monetary basis, and frankly, they should not. The name of the game is really to, get people, as quick as possible back to consuming, and in the meantime, avoid, personal and as many corporate bankruptcies as possible. On the fiscal side, it's actually a little bit more interesting, given that the number is bigger. The central bank has come out with a relief package that is worth, $1.5 trillion alone. That relief is split into a number of sort of measures itself. One is the typical lower reserve requirements and capital requirements for the banks that, in theory, should allow the banks to lend more, which is not the case. The banks are not giving credit. I think everybody's holding back on credit right now, given the uncertainty and the volatility of the outcome. If we don't know when the recovery is going to take place, it's kind of difficult to put, new funding in place, but it's going to have to happen. The second one is maybe the more important one, or at least a big chunk of this relief, is really the central bank committing half of that 1.3 trillion to buying corporate debt on the secondary market. That will be interesting for distressed people, but it doesn't necessarily add a direct stimulus to consumer spending. It probably has a multiple effect to some extent, but it's unclear really how that's going to help in the short run. In other words, the central bank needs to go in the secondary market and buy corporate debt from either banks or from funds or from corporates directly and bring that into their balance sheet. To the extent that that creates a trickle effect to make payroll or to inject money in the economy, I think that will be obviously favorable. But it's unclear to me really how they're going to be able to do that on the short term. In fact, anything beyond paying checks right now to a limited amount of people, right, on the monetary stimulus, it's probably going to be extremely slow. As for direct loans to small and medium companies, I'll talk about that for a second, but I think that's the other big component that we're seeing in other countries, and that will be a big help, but it's really difficult to believe that it's going to happen very quickly in Brazil. So what are the takeaways for us, or what is this really telling me? The fiscal package to supplement low income is great, provides relief, but it's probably largely insufficient. So we're going to need more than that. The loan schemes, as I said, for small and medium companies are so difficult to implement. We've seen, for example, in Great Britain, in France, and even in the US with the CARE Act, to be able to implement those direct loans are fairly complicated because of the paperwork that needs to be filled. Only the Swiss have been able to do that, and they've done that in a matter of days. So the ability to get money to businesses, for them to put that to work, i.e. to make their payroll, I think will be a matter of execution, a matter of implementation, which is going to be very difficult. So the agility of the government in putting together these relief packages is fundamental. Finally, I think the central bank buying corporate debt, again, as I said, it's a great monetary tool, but I'm unclear whether that's really going to help in the short run to begin with. So I think the audience has to be sort of prepare as businesses or as advisors or as CEOs or as general counsels. You have to be prepared for a sharp reduction in activity. We are already seeing it, but I think we have not seen the numbers yet. We will see the numbers, and I think the numbers will be terribly scary. So people will fall behind their payments. People will stop consuming for a period of time until we have a recovery. Whether the recovery is a V-shaped recovery or a U-turn recovery or whatever it's called, it will take some time before we get there. So that's one aspect. The other aspect I wanted to discuss is that there is another phenomenon going in parallel, and it's the downgrades of many, many companies. And particularly the downgrades of what we call the fallen angels or the angels of the economy, which are really the big companies which are credit rated for investment grade by portfolio managers. A lot of those are falling behind, and they're gonna be downgraded. They have not been already, and that's going to create a different dynamic in the market, and that will be important for restructuring, and especially for our field itself. We're going to see the automotives, and we've seen a number of other AAA companies fall under grade. They're going to be basically divested by portfolio managers, and those companies are going to fall into a different territory, which is unheard, or at least hasn't happened in at least 10 years. They're going to be distressed companies. So I got to believe that distressed players are going to be very active in picking up these companies because they offer obviously more liquidity, and they're a lot easier to restructure in a way than traditional distressed credit. So a former investment grade company that falls into distress today has more liquidity, probably has some sort of a business plan, and probably has access to government help to some extent, or may have a better chance than anybody else. So therefore it becomes a very attractive and more liquid investment than anything else. Why am I bringing this up? Because I think the economy in Brazil for a period of time has been in recession for the last 5 years, where we're just beginning to recover. A lot of companies are still struggling. A lot of companies have too much debt to begin with. Call that over-levered companies, which are going to have a really hard time getting out in this environment. It was difficult for them a year ago, 2 years ago, 3 years ago. It's going to be immensely difficult to do this. So to the extent that those credits, the existing and formerly distressed credits, the true distressed credits are still there, they're going to be difficult to negotiate. Probably you're going to have a lot of debt to equity swaps. You're going to have potentially the need for a more severe solution for businesses that don't have a real viability or real business plan versus the ones that do have. So a lot of advice to the clients or to businesses as to where they are in terms of exactly their problem itself. I think people have to realize, or people have to ask themselves the hard questions. As restructuring advisors, we tend to be as blunt as possible because there's no way to sugarcoat The bad news is always easier to come up with a solution if you have all the facts on the table. That's really how we go about this. So what's my advice, or what's our advice to the audience today is, ask yourself, what's the strength of your balance sheet today? I think if you go through the series of items that, or at least some of the items I'm going to mention, I think it will give you, at least a quick reality check as to where you may be in 3 months, in 6 months, in 9 months. And I think that's going to be immensely valuable to you, I hope. So what's the strength of your balance sheet? What is the supply chain looking like? Because you may be okay, but the guys that, are supplying to you may not be. Generally, everything is integrated, so I think it's not that difficult to figure out. How does FX, foreign exchange, impact the business? Today, we're sitting at 5.3 to the dollar. It is immensely expensive for Brazilians to buy anything as foreign goods. How are we going to project the recovery itself? That's a question I get all the time. That's really difficult. Is it 3 months? Is it 6 months? Really, all we can do right now is put together scenarios. And scenarios means I'm going to have projections with cash flows, and then I'm going to figure out if the recovery is in 3 months, is in 6 months, or in 9 months. What is my funding? How resilient am I to those scenarios? What do I need to do? Should I, go and bang at BNDES door today to get an emergency loan? I think these are all maybe the immediate steps that businesses need to take. If we think that the relief package will be slow, get in line right away and do what you need to do. Sell assets. In other words, you have to put together a reorganization plan of the sorts, obviously, that is coherent and gives you some visibility. Transparency and communication with your creditors is going to be important. It's always a better policy to be upfront with your creditors. I think you gain a lot more credibility with them in terms of trying to get to a quick negotiation. The banks are being flooded with restructuring situations right now. Credit officers that generally have 15 to 20 cases are probably having 60 to 70 cases, talking corporates right now, because individual cases, I think they're right now sitting in the millions in Brazil already. So your ability to come out of this, it will largely depend on your ability to get funded and your ability to restructure existing credits. And your ability to restructure existing credits is going to be largely, driven by your credibility, your communication, and your transparency with your lenders. I think they're going to have obviously more leeway towards, a viable business plan and transparent business plan than not. So having said that, I'll stop there. I hope, you get professional help. Obviously, that's what we're here to do. And hopefully you get creative ways of getting funding. I think that's where we can certainly help, because that will stand a better chance for surviving. On that note, I'll pass it back to Roberto. Thank you.
I think that was extremely interesting and a great way to start our conversation. Now we're gonna, start the first part of our debate, and we're gonna be focusing on defensive measures to ensure and improve liquidity. And I think the first is to ask Marcos the following question. One of the first steps that a distressed company needs to take to stabilize the situation is to negotiate a standstill and a forbearance agreement with its financial creditors, lenders, and bondholders. Marcos, what are the key issues that management needs to address when negotiating such an agreement?
Thank you, Roberto. This is a very good question because when a crisis knocks on a door, this is not a moment to shareholders or the management to have pride or to show weaknesses. It's completely the opposite. It's a moment to be confident and to act with transparency, to be open-minded in the communication, and to be willing to implement new policies in the day-by-day business of the company. It is important to bear in mind that these type of negotiations will be very different for the situation of each company itself. And it's very important to understand in which sector of the economy these companies are. So in distressed situations, the answers are rarely obvious. And as the players in distress like to say, the devil is in the details. So jumping to the question now, in my view, The key issues are, well, I think the first one would be to control the influence of the creditors in the day-by-day business by a very detailed negotiation with negative covenants. This is very important. Also, in the negotiation, the management or the people engaged to do this need to list all types of corporate reorganizations, be exhaustive about this. You need to understand what the company shall ask permission before to do this reorganization. And I have seen some cases that it's completely different for each one opportunity. So, for example, if a new shareholder with a primary investment will be considered go as a capital increase in the company, this can be considered as a corporate reorganization, especially if the control is preserved. So it's something to be cautious. Also, the third one I understand will be new corporate governance. For sure, this will be one key point here. And sometimes creditors may try to replace some members in the management, especially the CFO. So you need to take care of this and understand what will be the best position to have independent members or someone that is not aligned with the business of the company itself. Also, it's important to understand that they will request limitations on payment of dividends and other types of distributions, transactions to affiliates or related parties, and restrictions on guaranteeing the obligations of third parties. The fourth one, I think here also really important, and sometimes it's important to bring the founding shareholder or the controlling shareholder to the table as well, is to list and understand the collaterals that the company is willing to offer. So you should bring to conversation cross collaterals from the shareholders. This is very important. And the last one, I will point out 5 here in my view. Pay attention in the cash sweep mechanism. If this type of cash guarantee is on the table, well, you need to pay attention in the formula and define terms. Remember, the devil is in the details. So this type of cash guarantee is important for the company as well. So you need to understand what you can offer to the creditors. So once you go for these key issues, of course, you have much more, but I decided to list these 5 here, and I think it's really important ones. There is always opportunities to try also for a haircut on the debt. And to compensate this loss from the creditors, if they give you this type of haircut, in an equity kicker structure for the creditors. So if a liquidity event occurs, you can try to compensate the loss in the debt to something as an equity kicker if you gain. So everybody can gain together in a liquidity event, of course. So in my experience, the decision to call for these types of agreements should be executed as soon as you have the yellow light on. Because if you let the red light pops up, your negotiation for a restructure will change substantially. So throwing the ball back to my friend and partner, Roberto, I would like to ask you a question. So if a company has an outstanding debt and is unable to raise new debt financing in the capital markets or from its banks, what option are there to preserve cash, in your opinion?
Thank you, Mike. That's a very interesting question. Let me just take a step back first and address something that Sam has mentioned. I mean, a lot of companies are finding it difficult to get new financing right now, both on the banking side and in the capital markets. And the BNDES has issued a few programs to address that specific issue. Well, first of all, the BNDES has issued a program, a standstill program, for direct and indirect loans installments in the total amount of 30 billions. That means that companies with loans with BNDES can request for a temporary suspension of the payments of interest and principal for a maximum term of 6 months. And the request, the system is the request system is done electronically, so nobody has to get out of their homes to do that. But in addition to that, the BNDES has also issued new credit lines. For instance, it has issued a new credit line program for micro, small, and medium companies in the total amount of 5 billion reais. It has also issued a special program focusing on the health sector, which is a key sector at this moment. The credit line is named Emergency Health Plan, and it grants loans to with value between 10 million and 150 million reais to companies that provide services and products to the health activities. And it has also issued a company's payroll financing program in the amount of 40 billion reais. Basically, BNDES will grant loans destined exclusively to the payment of salaries in the maximum amount of 2 minimum wages per employee during 2 months to companies with annual revenues between 260,000 to 10 million reais. So, in a way, the BNDES is trying to cover that gap that companies are, facing in the banking and capital markets. But to address specifically your question, there are two alternatives for companies to refinance their debt, in particular in the capital markets. They have what is called a consent solicitation and an exchange offer. The consent solicitation is basically a request to investors to amend the original terms and conditions of the loan. In this particular case, to extend the term of the payments, to decrease interest, and typically when you do that, you have to offer something back to the investors, either new collateral to the loans, or new financial covenants, or new covenants in general. And in the exchange offer procedure, you basically propose to the investors that you're going to exchange the old debt with a new security instrument to replace that old debt. And the new security instrument will have different terms of payments, lower interest, and again, you have to give something back to the investor, like new collateral, covenants, financial covenants, etc. But as a matter of fact, Marcus, we have here with us today Chris, which has a huge experience in this transaction. So I wanted to take the opportunity and give the floor to Chris and ask Chris, what is involved in undertaking an exchange offer, and how long does it take? When does it have to comply with both Brazilian and U.S. rules? What are the potential risks? Chris, if you could share a little bit of your experience with that with us.
Sure. Thank you very much, Roberto, for that sort of overview. As you were saying, debt exchange offers are typically undertaken in order to restructure an issuer's balance sheet. They do not affect obviously the issuer's operations, except indirectly through the restructuring of the balance sheet, and also to obtain targeted relief from from debt service requirements under existing debt securities. Now, so there are both technical requirements to be met that I'll get into, but also very important timing, strategic and practical considerations that need to be kept in mind in actually structuring an exchange offer to ensure that it is successfully executed. First, you asked me about, when does an exchange offer require compliance with both Brazilian rules as well as U.S. rules? Well, the answer is, if you have U.S. investors who are holders of your bonds, you then have to comply with the U.S. federal securities laws. And what does that mean? Well, there are basically two sets of rules that you need to comply with. The first is the rules under the U.S. securities laws that govern offerings of securities. And what that requires is basically the same process, the same documentation that an issuer, a company, has to prepare when it's doing an offering of securities for cash. So that means preparing a prospectus or an offering memorandum that has to give a fair and accurate picture of the company's business, its financial situation, its liquidity, what the risk factors are, what the risks to the holder are of not participating in the exchange offer. So if there's an investment bank involved in the process, acting as dealer manager, pursuant to a dealer manager agreement, that would require, basically going through the whole, due diligence process by the bank and its counsel, delivery of opinions and the like. So it's not a process that can be switched on overnight. It takes a good month or so to get the documentation ready, and then there are a separate set of rules under the Securities Exchange Act in the U.S. that govern the actual conduct of the exchange offer, which is treated under our rules as a tender offer. So that means that it has to be kept open for a month, 20 business days, and it has to be extended. The exchange offer period has to be extended if there is any material change in the terms of the offer, such as an increase or a decrease, an increase in the amount of consideration offered, or an increase in the percentage of securities that is being sought. I mentioned that there were also strategic and practical considerations. Frankly, I think those are the more important ones to be focused on. And really, you asked, what is the risk? The main risk of conducting a debt exchange offer is that you go to all the trouble of preparing for it, and then nobody tenders, nobody participates. And so it's very, very important in designing the new security that you're going to offer, or package of securities that you're going to offer to the bondholders, that you structure the exchange offer and you structure the terms of the new security to maximize participation and minimize holdouts, meaning investors who decide not to tender and hold on to their security because they think that it'll give them better protection than if things go downhill than if they were to tender in the new security. So what are some of the key structuring issues that a company, together with its financial advisor, such as an FTI, would need to keep foremost in mind in designing an exchange offer that maximizes participation by holders and minimizes the holdout problem? I'll just mention a few issues that should be kept in mind and that are always addressed by issuers with their legal advisor and their financial advisor in structuring these. First, will the company offer any kind of what's called an early bird fee, meaning extra consideration that is offered to those holders who tender early into the tender offer, into the exchange offer? And that doesn't have to be in the form of cash. It can be paid in kind in the form of additional new securities. Second of all, what will be the ranking of the new security? Will it be ranked equally or pari passu with the existing security, senior or junior to that existing security? Next issue is, the exchange ratio. Roberto mentioned a possible haircut. Will the same principal amount of security be offered in the new security, or will there be a premium offered, or what? In the event of a haircut, the new securities offered may include an equity kicker in the form of actual equity securities, warrants, RIC and I actually worked on a transaction last year for a Mexican issuer where the equity kicker was not in the form of shares of the company, but actually in the form of contingent value rights. It was a very complicated instrument that was tied to the resumption of activity under a contract, an EPC contract that particular company had. Obviously, other factors that need to be taken into account in the structuring are the interest rate, whether the new securities will be guaranteed by the issuer's parent or its subsidiaries. Roberto and Marcus also mentioned collateral. Will the exchange securities be secured by assets of the issuer, the parent, or the subsidiary guarantors? In the area of collateral, if there's other debt out there in the capital stack that is secured, if you are granting security to the new notes, there are intercreditor issues that are raised that will require negotiating an intercreditor agreement. So these are a lot of issues that have to be taken into account in structuring the exchange offer. A word on process. It can be very helpful, in fact critical, in ensuring a successful exchange offer process, particularly if the bond ownership is concentrated in the hands of a small group of holders, to try to get those holders to organize as a committee, an ad hoc committee, so that they hire their own financial advisor and their own legal advisor, bring them over the wall so that they agree to restrict themselves and not be able to trade by getting them to sign non-disclosure or confidentiality agreements, and negotiate the terms of the new security and the exchange offer kind of in advance with that small ad hoc committee, so that when you then go out to the broader group of bondholders with your exchange offer document, you know that you have the support of a critical mass of bondholders to get you to the level of participation that you need. Exchange offer, I mentioned carrot and stick, or incentives and disincentives to induce participation. One technique that is often utilized is to combine an exchange offer with something called an exit consent solicitation. What is that? So a consent solicitation would be while you're asking holders to exchange into the new security, you ask those holders who do agree to exchange to consent to the stripping out, the removal of the negative covenants contained in the old security that protect bondholders. What does this do? This makes it very unattractive to holders to remain in the old security, and because they are left with a security that is effectively toothless aside from the promise to pay principal and interest. So that is a very effective tool for maximizing participation in the exchange offer. So coming back then to the risk of launching an exchange offer is that it fails. And so if you can't get enough participation in the exchange offer, you're not going to be able to restructure your balance sheet so as to reduce the amount of debt or stretch out the maturity as you would like. So one final point, an additional tool that Rick will get into, but I just want to foreshadow it for the audience, is under appropriate circumstances, an exchange offer can also be coupled with a solicitation of acceptances to what we call a prepackaged plan of reorganization under Chapter 11 of the U.S. Bankruptcy Code. So with that, I'd like to bring Sam back into the conversation. We've touched on a couple of times financial advisors and the role that they can play. Sam, I wanted to ask you, what is the role of the financial advisor in preparing for a restructuring, not just a debt exchange offer, but a debt restructuring generally? How do you add value to the process, I think is a critical point for our audience to understand. And how does your role differ from that of the legal advisor? And finally, when is the right time for a company to hire a restructuring firm to have it at its side as it goes into these various work streams? Sam?
Thank you, Chris. Primarily, we work with counsel in assessing all the economic and financial issues that are going to be addressed. I think trying to obviously not only produce but to vet and to generate obviously and facilitate a good discussion with the creditors. A lot of our work is at the basis explaining complex issues and making it simple issues. So we try to give comfort to the numbers to try to make a discussion on the numbers as quick as possible. I like to say that we need to measure the size of the pie, and we need to convince all the stakeholders as to what the size of the pie, and that we can take that away because the real discussion is about how do we divide the pie. That's often where a lot of time is spent, and really we do a lot of negotiating on behalf of the company. We do follow obviously what the boards and what management objectives are, but we fundamentally try to preserve also management. It's a time-consuming, very punitive sort of function to go and fight with your creditors a lot of times. So you want to make sure that your management is doing the more value-added stuff, which is really running the company, especially these days. Timing-wise, the sooner the better. If the company has liquidity and they see an upcoming restructuring, a financial advisor will be much more cost-effective early in the process than late in the process because the company has cash. And we could help them, obviously, negotiate not only with the creditors, specifically the financial creditors, but with others, with suppliers, and trying to preserve that cash as much as possible. Again, trying to preserve management in front of a bunch of stakeholders, which are obviously aggressive, and we're the first line of defense. Finally, I think we do a lot of, participate heavily in plan support agreements. I think that's where your skills and our skills really sort of come together. We have to basically find friends in the creditor group that are going to help us push, a deal through, and that's important. So there will be a lot of negotiations on the economic basis and really what are the main legal terms associated with that. Once we have a group that we can start growing, obviously in the more complex processes, that will add a lot of value. Having said that, I will pass it back to Roberto at this point. Thank you.
Thank you very much, Chris, Sam, Marcus. So let's quickly move to the second part of our discussion, which will deal with judicial system trends, new legislation. Few messages before that. First of all, don't forget to put your questions in the chat section of our webinar. And second, you're not seeing Rick, but Rick is here with us, and he will be addressing the U.S. law parts of that of this topic. So, having said that, let me ask Leandro. Leandro, what are the main difference between the extrajudicial restructuring, prepackaged restructuring, and the judicial recovery? And what needs to be taken into consideration by a company when deciding, which proceeding to use? And in addition to that, considering that proposal to amend the bankruptcy law has been recently presented to the Congress on an urgent basis to provide companies with additional protection to face the COVID-19 effects, can you explain what are the most important changes that will be voted? And what are your expectations in relation to the approval?
Okay. Thanks a lot, Roberto. Well, in relation to the first question, the main differences between the extrajudicial recovery and the judicial recovery are basically the moment in which you negotiate. The judicial recovery proceeding, which is most commonly used in Brazil, is a proceeding in which you file a petition first, you get a court protection, creditors will be prevented from exercising their rights, and then you have a breathing room to negotiate a plan with creditors, and this plan will be voted in a creditors meeting. The extrajudicial recovery on its side is a proceeding in which you negotiate first, and once you get the approval, then you file it for a judge's confirmation. So the main difference is the moment in which you file the proceeding. The extrajudicial once you file it, you already know the plan was approved, so it just needs a court's confirmation to drag the dissenting creditors. In the judicial recovery, you file it and then you negotiate. So once you file, you don't really know if you're going to get the approval or not. So this is the main difference between the two proceedings. Of course, there are several differences. We don't have time here to go through all the differences, but I think this is the main difference. And in relation to what needs to be taken in consideration for the company when deciding which proceeding to use, I think the first one is the nature of your debt. Basically because labor creditors cannot be restructured through an extrajudicial recovery. So if you have problems with labor creditors, then the extrajudicial recovery is not an option. You have to use the judicial recovery proceeding. And we all know that labor claims in Brazil can be a nightmare to a company's cash flow. So this is the first item to be taken into consideration. The second one is timing. Even though the extrajudicial recovery tends to be a more quick proceeding, it's easier to be concluded, the negotiation prior to the filing can take a long time. So if the company needs an urgent matter, an urgent decision to protect it from the creditors, maybe the judicial recovery is the best option because you need no negotiation, you just file it, get court protection, and then you have a breathing room to negotiate. So depending on the timing, the judicial recovery is the best alternative for you to react to unexpected measures. Second item. Third item is costs. Extrajudicial recovery tends to be more simple and more cost efficient because, especially because in the extrajudicial recovery, you don't have the judicial administrator, which is a court-appointed expert that will supervise the company's activities. In the judicial recovery, the judicial administrator is mandatory and has to be paid by the company, by the debtor. And the extrajudicial, it's not mandatory. There's no provision authorizing its appointment. But in some exceptional cases, the judges decide to appoint it in extrajudicial recoveries. So costs is also an issue. The fourth one, I think, is the risk of bankruptcy. This is also very important because in the extrajudicial recovery, after you get the approval, you file it for a court's confirmation. But there are some cases in which the confirmation is denied by some problem, maybe because you don't have the minimal quorum of approval, maybe because there's an illegal provision. But if the judge denies confirmation, he will just dismiss the case and the case is over. In judicial recovery, if the plan is rejected by creditors, the judge will convert the proceeding into a bankruptcy liquidation. So this also has to be taken in consideration. And the last one, and maybe the most important, is because in the judicial recovery proceeding, the judge plays a greater role in protecting the company's assets, not only from the creditors that are subject to the proceeding, of course, but also to other creditors. For example, tax creditors. So it's harder for tax authorities to collect the assets of a company under judicial recovery than it is an extrajudicial recovery. So the role that the judge plays in the judicial recovery is a lot greater than the extrajudicial recovery. This is also very important because for a company that's under court supervised restructuring, you need to manage your cash flow, and it's hard to manage a cash flow if you have judges fishing money out of your bank account every time. So these are items that have to be taken in consideration. Of course, this decision has to be made alongside with a lawyer, a financial advisor, but these are some important items to consider. And of course, whichever proceeding you decide to follow, or even if you're just negotiating with your creditors, it's advisable for a company to have a judicial recovery ready to go. That's what we call a standby judicial recovery. And the reason is because it's the best way for you to react to unexpected measures. So even if you're just negotiating with creditors and you're not even considering filing something, just leave a judicial recovery ready on your shelf, because if you face an unexpected measure, for example, a petition for bankruptcy from a creditor, you'll be ready to react. And drafting and preparing a judicial recovery, you cannot do it overnight. You have to draft it. There's a lot of paperwork to be done, and you have to analyze all the contracts to understand the nature of each creditor. So it's really important to have it in advance and keep refreshing the documents every once in a while. So those are the items to be taken in consideration. Now, in relation to your second question, in relation to the project of law to amend the bankruptcy law, it's not only amending the bankruptcy law. It's a project that was presented to Congress 2 weeks ago, that creating some rules to protect companies from insolvency. So basically, what it does, I think the most interesting part of this project is that it creates an automatic standstill for any company, regardless of any filing. You don't have to file anything. If any discussion with creditors is related to the unfulfillment of an obligation that occurred after March the 20th, this discussion will be automatically stayed for 60 days. So it's a standstill mandatory for all creditors in this situation. So this gives the company a breathing room to negotiate. And after those 60 days, if the company is not able to actually negotiate with those creditors, the company can file an additional proceeding. It's called a preventive negotiation proceeding, in which the judge will give another 60 days for the company. So at the end, the company might have 120 days to renegotiate with creditors before having to face any legal measures to enforce. And during this proceeding, no fines can be applied, no enforcement proceedings can move on, no eviction can be made, no repossession claims, no guarantees can be enforced. So it's extremely interesting. It's basically a standstill mandatory for all creditors. Of course, it's a little controversial because there are some rules in the law that will probably make creditors to pressure for changes. One of them is a provision saying that all guarantees in money and receivables will be released up to 50% to restore the company's cash flow without the creditor's consent. So I expect that this provision and some other provisions will cause banks to make pressure to change it. So this could delay the approval of the proceeding. So I think it's a very interesting project. I hope it gets approved because it's going to help companies, not only companies that are trying to prevent insolvency, but companies that are going through insolvency proceedings. They could take benefit of this mandatory stay period. It's going to help all those companies, but it depends on the approval of Congress. And even though it's a matter that, in theory, it's urgent and would make the Congress to approve it on an urgent basis, I think those controversial items could cause some pressure to change the law and delay the approval, unfortunately. So basically, those are the answers to those questions. But I want to transfer to Rick Chesley. I have a few questions to him. First one, I read somewhere one time that a Colombian company filed for bankruptcy protection in the U.S. So is it really possible for a Brazilian company to, instead of filing a restructuring proceeding in Brazil, to file it directly in the U.S.? Is it possible? And if so, how would that work?
Sure. Appreciate it and appreciate the opportunity. Sorry I couldn't be on video. With respect to the U.S. proceeding, and really what we're talking about here are more akin to insolvency proceedings, not bankruptcy. These are really in furtherance of a restructuring, not a liquidation. So I think it's important to understand that as a predicate before we move on. And I want to be brief to leave time for questions, but the answer is yes. The U.S. process is really a global process, and the jurisdictional limits to commence a U.S. proceeding are relatively minor. Now, there are some impediments to it. There's obviously the cost, but tying into where Chris led off in the use of the exchange offer, the Chapter 11 or the reorganization proceedings can be very effective to execute what's called a prepackaged bankruptcy in the U.S., a prepackaged insolvency under Chapter 11. And that means you would be under protection of the Chapter 11 court for a matter of days. Now, what that requires is obviously, the preparation and obtaining the consents prior to the commencement of the proceeding. And it also obviously is dependent upon having a balance sheet restructuring. It's really not a good tool if you have local trade, local employment, or other local obligations. It only really works to the extent you're going to pass through or honor those or extend those obligations. It's really a way to reorganize the balance sheet very effectively and efficiently. And oftentimes we will use that process, or more importantly, the threat of that process, to get the exchange offer consummated at a threshold that we need. So for example, again, if we look at the economics and we need 90% to exchange to deal with the holdouts, and we only get 75% to do it, and the economic risk of that 25% holdout class is so extensive, then a U.S. prepackaged plan can be a very effective tool to restructure that debt and implement the restructurings within a very short time period. So the long answer to the short question from a restructuring lawyer is yes, the U.S. proceedings are very effective and can be used expeditiously, again, depending upon what we're attempting to do in reshuffling the balance sheet.
Okay. And an additional question. If a company files the proceeding in Brazil regularly, assets or subsidiaries in the U.S., how does it work? Do we have a proceeding in the U.S. to protect the assets from creditors?
Yeah, what we have here in the U.S., which is common in a lot of countries now. Brazil doesn't have the same treaty protections that other countries do, but it can still be used in the U.S. and has been, is what's called Chapter 15. And what Chapter 15 does is it extends the stay, the Brazilian stay, to any assets or creditors in the U.S. from taking any action. So that is done in conjunction with the Brazilian filing. You get recognition of that proceeding in the U.S. And again, all creditor actions against U.S. assets or entities are stayed pending completion of the Brazilian process. So I think the point of all of this is these two systems, while they are different, there are enough similarities that they can work together seamlessly to effectuate a restructuring throughout, obviously, the Americas, and certainly there are other countries that can be involved in this. So again, all of these pieces do come into play, and I think what's important to everybody as we're looking at these very challenging times is to understand what the legal tools in the toolbox are to try to get through this difficult time and navigate through it. So I think at that point, I'll turn it back over and we can hopefully get some questions answered, and appreciate everybody's participation today.
Thank you very much, Rick, Leandro. We wanted to keep this webinar within the 1 hour time frame that we have set for the beginning. So we have received a couple of questions through the chat. We will answer all the questions by email, but I will wrap this up. Thank everybody. Thank Marcus, Chris, Leandro, Rick, and Sam for participating in this debate. I thought it was extremely helpful. And I also wanted to thank everybody who joined us today to listen to the discussions of this seminar. Thank you very much. Again, we will be answering all the questions by email. And I think with that, we'll end this seminar here. And again, we will have another CMA seminar next Monday on tax. If you are interested, you can check our social media. Thank you very much, everybody.